Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at an update on our most recent vol capture trade on SanDisk SNDK, where we kind of got the best of both worlds with the stock dropping on an overbought and overvalued SanDisk, and even with the stock dropping sharply, IV dropping as anticipated simply because that had gotten to an extreme as well. So taking advantage of extremes once again pays off. So let's jump in and take a look. First, here is the kind of simple valuation metric we used. Here was the original trade from February 24th. You can see SanDisk price to sales ratio over 10x, right? By far the richest valuation we have seen in a very long time, if not ever. Fast forward to the close. Today, you can see that price to sales has softened certainly appreciably, going from basically 10.5 to 9.5, which is a pretty sharp drop on the price to sales ratio. All that because of the big drop in the stock price, right? So jumping over to take a look at that, we can see the stock, which was floating right around that kind of 700 level, running into some overhead resistance. Here's where we put on the trade right here, where we had this kind of reversal. We had a slightly bearish outlook on the stock, certainly a bearish outlook on implied volatility, which really hadn't dropped much since earnings, right? So we expected a reversion in IV and probably at some point a bad hair day, if you will, in SanDisk. Lo and behold, we got that over the past several days. SanDisk closed down sharply, right? You can see that overbought condition certainly has softened dramatically, now getting almost to oversold levels. MACD switched from the highest level we have basically seen over the past year to the lowest level. That's how fast it moves, right? Bollinger percent B looking like it wants to go negative, and then surprisingly enough, implied volatility, we'll take a look in a second, actually dropping even with this sharp drop in the stock price. So IV, as we said, moved from, here's where we put the trade on. This is post earnings. The IV actually ramped up, believe it or not, because of the AI infatuation. Here you can see from the 23rd to the 24th of February, especially on the long end, that jump in IV. IV, which earnings were back here, right? We saw the normal vol crush right back at it. Vol basically back at pretty much the levels it was before the earnings came out, right? So we like to take advantage of that, certainly. You can see what happened today. Finally, IV starting to soften and enough to have it be a very nice profitable trade, right? Here's the day we put the trade on, right? We can see IV going from over 100, right, on basically a generalized IV to under 100 sharply on that. That's all we need to have a very nice gain on the trade. So taking a look at the strangle, here's where we put it on, right, with the stock at 638.52, right, on February 24th. We can see the sell strangle selling to 600 put and the 1030 call, right? We were able to get over $600. So as we said, no downside on the stock. The upside way, way out of the money, right? By over 170%. The upside break even at 1632. More importantly, able to sell that IV at 93. Take a short position, believe it or not, even though with the stock at 638.52, the 600 put just barely out of the money. That 1030 call well out of the money, but a much higher IV on the call than on the put. Fast forward to today's close, we can see that that same strangle, right, closed at 543, so a very nice drop, right? We can see that the calls dropped under 90 IV, right? When we put the trade on back then, trading at almost a 92 IV, so a very nice drop in IV on the calls, right? The puts, the same idea here, right? When we put the trade on, right, the puts trading over a 95 IV. Fast forward to today, you can see trading under a 92 IV. So we had the drop in IV by selling implied volatility, able to profit from that, taking a bearish stance, believe it or not, even though the call is further out of the money. We were about 50 deltas, right? net short 51 to be exact, right? With the stock dropping, we got that best of both worlds. So taking a quick look at the wrap up, we put the strangle on February 24th at 602.65. The IV was at 93. The stock price at 638.52. Fast forward to today, the strangle closed at 543. So a very nice gain of almost 60 bucks or almost $6,000 for each time you did it right. Why? Because we had the IV drop, even with that big down move in the stock. Normally you'd expect IV to ramp, but because we sold it at such an extreme on these AI names, it actually dropped as anticipated. And we had the stock price drop over 70 points, so a sharp drop of over 10% on the stock. So we're able to make almost $6,000. As we said, the margin initially on the trade just under $9,000 to sell at one time, right? So with a roughly $9,000 margin and making about $6,000, you can see a 67% return on risk for taking a fairly safe trade, right? Just waiting for IV to revert, which it did, waiting for an overbought SanDisk to drop, which it did. So we anticipated both of those. Both of them came to fruition this time. It doesn't always happen that way, obviously, right? But taking this fusion approach where we look at the fundamental, technical, and especially IV analysis, fundamentals were pointing to the richest valuations basically ever in SanDisk. Technicals, as we said, pointing to the stock being as overbought as it had been in the past year. IV at basically the highest level and back to where it was pre-earnings, right? Even with earnings coming out, IV ramped higher, so we're able to take advantage of the expected reversion in all three. These have a very nice short-term trade. Doesn't always work out that way, as we know. Trading is all about probability, not certainty. But as long as you find the edge, put on the hedge, and position size accordingly, you should do just fine. So until next time, as always, here's the good trading. Take